September 12th, 2023. You could argue that, we started down on 80 yesterday and we got follow through. The gap is essentially a bear bar. If you think about it, the gap down, it's just a big bear bar. So you could say we got a leg one, pull back, leg two measured move down to here. And the pullback was essentially just a bull spike. And so the bull spike from here to here. And that also was a measured move down. That's about where we went to. You know, you can use those, but I think it's more important to pay attention to all of the big bull bars that we were getting, 1, 9, 13, especially like 19. When you start getting those big bull bars, you should be looking for a reversal. It's obviously going to reverse at some sort of measured move target. It always does. But, I think it's more important to be paying attention to the fact that you're getting these big bars and just be looking for a spot to buy. Big gap down and big bull bar on bar one, closing near its high. It's a good bar, but there's an 80% chance of a minor reversal on the open and a 50% chance that the first move is going to be completely in the wrong direction. So when you get follow through on two, it's not quite what you want. If you think about it, it's actually pretty disappointing. Bulls who buy above one want a big follow through bar that looks pretty similar to one with just no tails. They want a big bull follow through bar. And so when you get two, it shows kind of a lack of conviction on the bulls. I mean, if you bought above here, your fill price is 4530.25 and this bar closed 4530.25. So if you bought above one, although two is a bull bar, how much were you able to make by the close of bar two? You didn't make anything. You're still at break even. So that's not really what you want to see if you're buying above a bar like this. Three, bad follow through for the bulls. As expected, minor reversal down. Probably going to form some sort of double bottom and attempt to go higher. Probably buyers below three or a point or two below three. Probably sellers above three. Bar four, buyers below three. And bulls pretty much looking for a high one to buy, maybe on five, maybe on six, looking for follow through. But the problem is, if you bought anywhere up here, you're probably looking to get out around break even. And so when we get, after we get five, I'm not sure how much higher six is going to go. Additionally, on bar five, it is a double bottom for the bulls. So good for the bulls. Bears are going to try and form some sort of double top here. But you have to keep in mind that there's a tail on the top of five, which will reduce the amount of traders willing to buy. So still probably more sideways rather than anything. Six, bad follow through for five. Again, it's not the worst follow through, but you really want a big, strong bull bar closing near its high and probably breaking above the neckline of the double bottom, which is bar three high. The neckline is the highest price between the 2 points. Similarly to when we get disappointing follow through on seven and the neckline of the double top is the bar four low. Sorry. So the neckline of the double top on 3 and 7 is the bar four low. Something in trading ranges that you should think about is just what would disappoint traders. So if you bought above five, you don't like six necessarily, but you don't hate it either. But what would really disappoint you is if we traded below six, right? Or if we got a bear bar. And then when you get the double top on seven, what would really disappoint bears on seven? Well, we went down, so that's good for the bears, but we didn't close below the neckline. So that might disappoint the bears. So basically, if you're in a trading range, if you think you're in a trading range, just think about think about what would be disappointing to you if you were in the market. So if there's a potential bull stop entry, like a buy above bar five, sit there and think about, well, what would disappoint me in the next bar? Obviously a giant bear bar, but what are the realistic possibilities of what's going to happen next that could disappoint me? And then if you get follow through, think about what would disappoint you on that bar as well. And if the disappointing things keep happening, you should keep in mind you're probably in a trading range. But once you start to look for, if you're looking for disappointment, buying above a bar, and you keep not being disappointed, then you have to start thinking you might be in a trend. Like a better example of that, which, if there's an easy bull trend somewhere in the past couple of days, if you sold below, let's say you sold below six, just keep it easy. What would disappoint you? A sort of sideways bar. Seven's a great bar. You might be a little bit disappointed in this, but it's not enough to make you get out of your trade. It's probably just a pullback, which you'd expect after a giant sell climax. And you note that it would be disappointing if bulls were able to touch the three low, because that would mean that limit order bulls who bought and bought more lower were able to get out at break even, making your bear trend less strong. But they were never let out. So you can see that you're not as disappointed because the three low and the 10 high didn't touch. You're not as disappointed when body gaps stay open. So when you're not disappointed, you should be expecting, more of a trending environment. And when you get very disappointed with the follow through, you should be expecting more sideways environment, I guess. So bar 9, it's potentially a wedge. You have a big bear bar on basically the gap, and you could argue it's 3 pushes down. So it's a wedge bottom with 9 and a reasonable swing buy. But 10 is a disappointing bar for the bulls. You could also, by the way, say that this whole thing is 1, 2, 3. You have the the lower high, the lower high, the lower high. So you could argue this is consecutive sell climaxes down to this, which just means maybe tomorrow we're going to get some sort of bounce for a couple of hours, which wouldn't surprise me. But anyways, bar 10, bad follow through for bulls who bought above 9. If you bought above 9, you wanted a big follow through bar through the moving average, you got a disappointing bar on 10. What a lot of traders will do, rather than trying to get out at break even, they'll just flatten at the market. And so you can see if you bought above 9 and on the close of 10 you're disappointed, a lot of those traders just click sell the market or flatten or whatever your button is, and that's what caused the micro gap and causes the big bear bar on bar 11. Additionally, it's a 1 tick trap above 9. So if you bought above 9, you got filled and you never had even a cent of open profit. So you were immediately trapped into a losing trade. And when you have trapped traders, the market often makes a couple legs down. And so I think it's reasonable to take the short below 11, looking for a couple legs of follow through. Also, 11 closes below, these resistance point or these support points. And the next big thing is, the 1 low. But you have to keep in mind, it is a trading range day. And so traders who buy below 1 and buy more lower should be able to make money. It should come back to their initial entry. So when you're selling below 11, you have to be cautious about the 1 low, because you know that even if we go below it, there'll probably be a little bit of a bounce. 12, follow through for the bears, but a tail on the bottom, but it's still okay follow through, enough to stay short. 13 is a big reversal up. I don't think I would buy above 13, but I think it's reasonable to look to exit shorts above it. But you can see that it never triggers, and we get 14, which tests essentially the close of 12 and lets some of the traders who, if you sold the close of 12 or sold anywhere down here, you're disappointed at 13. Those traders are trying to get it out at break even on 14, and you get a second reversal up on 15. It's contracting, so it's obviously some sort of triangle, but I don't think it's necessarily all that strong. I think the most likely scenario here is that we're going to continue sideways, and you can look for some sort of reversal up, but this is a decently tight and strong move. So I think we're going to get another leg down. 16, low 2 short for the bears, but overlap with the 1 low. And all these bars are overlapping. And so while you might get a breakout, it will probably be brief. 50-50 chance you get a good breakout of the tight trading range, 50-50 chance we stay, the first breakout fails. So when you get 17, it's a good bar for the bears, yes, but you need more. You need more follow through on 18. You don't want them to get back to this 13 low. You want to just see 18 immediately sell off and look pretty much exactly like 17, and it traps traders below this, traps traders below that. And instead, you get 18, which pulled back almost all the way to the 16 low. So any bull who bought the 16 low and bought more on the close of 17 was able to get out with a small profit. And so that's really disappointing. And you also have to keep in mind there's a 90% chance that we break out of the 18 bar range, and sometimes it'll basically just immediately fail once it breaks out. So you can see after bar 18, we knew we probably had to trade at least 1 tick below, because there's a 90% chance you're breaking out of the 18 bar range. And at this point, it's nothing's 100, but it's probably like 99.9% on the close of 18 that we're gonna break out of the 18 bar range and most likely go below 18. So you can see once we got there, a lot of traders were just waiting for that, and they bought back their shorts at the market, and we got a big bull bar on 19. Now, this really doesn't look like any bear trend day that you're used to when you get a big bar like 19, bull bars here. This is, it's not great for the bears, but they could have overcame it, except they just, because it's the opening range, and so it's usually going to be a trading range open, and sometimes it'll turn into a trend. But with all these, with this bull bar, it's probably going to be more sideways. So again, outside bar 19, outside bar on 20. Really just, breakout mode, trading range price action. I think, 20, anyone who sold any of these closes is using this as the second leg to exit around break even. No one who sold is happy with 19. And so they're looking to get out, even at the low close, maybe. So once 20 gets bought back up, any bears who sold anywhere in here, disappointed. So they use 21 to buy back shorts, causing a rally. So we have outside to inside, just very tight trading range, very much breakout mode. And then you get 23. Doesn't close on its high. At this point, you should be thinking swing up. It's a trading range day, so we're probably going to get to the open of the day. And on trading range days, gaps close. So the 10 low is an important magnet. You can see we got there on 30. And reasonable stop order traders, if you take a reasonable stop entry and you scale in, you should be able to get out at break even as well. And so I think that, the traders who traders who bought above 9, I was thinking that the traders who bought up here were also going to be let out at break even once we started to rally. So I thought 24 was a reasonable buy, looking to get to the 10 low or maybe the 10 high, those traders, so they could get out. Follow through on 25, but not amazing. Bulls want to put, basically a full bull close above the moving average, or a full bull body above the moving average, which they're not able to do until 28. So bad follow through, kinda, on 25. Definitely bad follow through 26 and 27. It's disappointing for the bulls, but there's no real reasons to sell yet. So okay to stay long. Basically, you see we just tested the open of the day and sold off a couple times. So market failed to go down on 26. Pulled back, failed to go down again on 27, and started to pull back. So you can see it's two failed bear reversal attempts, and we get follow through on 28, 29. Buyers below 29 on 30. You can see that 29 tested the 10 low, so not surprised we found sellers there. And then you get a big bull bar on 31. But you got to be a little suspicious because you have this push and then buyers below 26, so that's one leg. This push, buyers below 29, that's two legs. And then you get a big bull bar, probably the best looking bull bar since the breakout on 31. And you're at the top of the trading range and it's a third leg up. So when you're at the top of the trading range and a third leg up, you should be pretty resistant to wanting to buy. And so it makes more sense for traders to start taking profits. And you can see at the high close, bulls just started to sell. And so when bulls are selling, where was I going with this? I'm just trying to think of the way I was trying to word that. You're at the top of the trading range, you're in a third leg, so you have to be expecting traders to sell. And so bulls are going to sell at the market. Other scalpers know that bulls are going to sell at the market. And so they'll be buying these pullbacks knowing that it's still a tight bull channel, because we are still in a tight bull channel. But if you're doing that, those traders know that they're probably going to be scalping out at the top of the channel. It's not a very good, very smart strategy unless you're a really good trader. 33 follow through for the bulls, but again, not that good. We got two dojis in a row. Same thing as over here, probably in the third leg up. And you get 34, probably buyers below. You can see there were, but are we going to get a fourth leg up at the top of a trading range, or more likely that we're going to go sideways? And then you get 36, a bear bar, but a tail on the bottom. A lot of bulls will just exit on the close of 36, thinking that, the main reason anyone would be holding up here is hoping we get an upside breakout of the channel and we just race up, kind of like we did over here. It's a pretty good example of what those bulls were looking to get. But once you get 36, that kind of removes that premise, so those traders are disappointed, thinking their premise is no longer valid. They'll sell it at the market cost 37. But I don't want to sell below 37. It is a pair of bear bars, and it is, a little higher up in the trading range. It's more towards the middle, but it's still a little bit high up in the trading range. And it's a pair of bear bars. So in theory, you could argue it'd sell the close. But the problem is that, this was a pretty tight channel. And so on a higher time frame, it's a breakout. And so you can expect the first reversal down is probably going to fail. So you might have to find more buyers below 37 than sellers. And that's why you get buyers below 37 on 38. Additionally, 34, we're probably getting back, 35, we're probably getting back to 35 low and probably the 35 close, because it was a tight bull channel. So it was reasonable to buy bull closes. This is a doji, but it was still reasonable to buy that close. And so I think we're probably going to get back to this price. And you can see on 39, we got big follow through for the bulls, probably just a vacuum test of 34, 35. But probably okay to buy above 39, taking a chance that we get a swing, but it's kind of similar to buying over here. You need to be really quick to make decisions and quick to get out. 40 follow through for the bulls. It's not quite breaking out of this high, but I think it's okay to buy. But the problem is you need to either be willing to scale in lower, or you need to be really quick to get out. It's kind of the same thing as over here. You need to be willing to scale in lower or quick to get out. And even here, though, the traders who were scaling in a little bit lower, it's hard to want to keep scaling in once you see 11. I think you probably just take your loss below 11. But yeah, the reason being, there are a lot of trap traders, and if you're long and you have to take a loss here, you are the trap trader. Keep that in mind. So you're selling here where a lot of other traders are selling, and so that means you should probably be selling to go short more than just selling out of your longs. Bad follow through for the bulls on 41. but 38 to 40 is enough for a second leg. So probably more buyers below 41 than sellers. You can see not much follow through on 42, and 43 is the second leg for the bulls that goes up to the 40 close. If 43 closes on its high, I think it's okay to buy, taking a chance, but you know that they're probably going to get back to the 42 high. But if we do get back to the 42 high, there should be sellers. So follow through big bar 43 and failed breakout 44, sellers below 43. We get back to the 42 high. And you can see on 45, we now have an inside bar. And if 45 closed on its high, I was going to buy, thinking that we might have to take a chance. We might have to get back to the 78 low, middle of the trading range, maybe test yesterday's close, which I think that's pretty much exactly what we tested, right? Yeah, look at that. We tested yesterday's close exactly on bar 47. But 45, not quite good enough to buy above. And then you get 46 closing on its high, closing above, a lot of bars. It's the high close of the past, essentially 35 bars. And a lot of traders will buy the close of 46. And you can see that's why we got a gap up. And if you had a limit order to buy, the high of the bar, it probably wasn't filled. 90% of those limit orders were not filled on 47 since it didn't go one tick past it. It just went to it. And, this bar just raced up pretty quickly. And so, bulls were eager to buy. And in trading ranges, a lot of times you'll just get that climactic move and it'll erase all the edge really quickly. So big follow through on 47, but at the top of a trading range now, and the breakout is probably going to fail. You know this because it's been a trading range day all day, and you get climactic moves in trading ranges that are probably just second leg traps. You also, if your premise is still that it's true, you can only buy basically the close of 47 if you think it's a bull trend day now. But if your premise is, if you're looking at that and you think, well, it's still a trading range, then what's probably going to happen? The gaps are probably going to close. And so you got to immediately look to the left and see the 3 high and know that traders who sold above the 3 high and sell more higher are probably going to be able to get out at break even. So you got to be a little bit cautious about buying the close of 47, especially once you see bad follow through on 48. Which is why any traders who bought the close at 47, disappointed 48, used 49 to get out around break even at, whatever price they got long at. But you can see if you bought during 49, during 48, you might have been in a little bit higher. But if you bought on the close of 47 or any time during 48, you got out of break even. Even the bulls who bought the highest tick of 48 got out of break even during 49. So it makes more sense to wait for closes of bars a lot of times. 50, bear bar, potentially 2 legs down, reasonably tight, but I think we're getting back to the 3 high, but I'm not sure past that. And then you get a giant bear bar on 51. And when you get 51, I think it's okay to just sell the close, thinking this is a second leg trap. And you have the 22 high, which hasn't been tested. And in trading ranges, those gaps do close a lot. So okay to sell the 51 close, hoping to get back to that point. Additionally, traders who bought below 49 and tried to scale in, they got trapped on 51, and now they're selling out of their longs. And so you're probably going to have that fuel driving the market down. Follow through on 52, but big tail. 53 pulls back to the 51 low. So traders who bought here and bought more lower are able to make money, but it's still not good. You shouldn't be buying there. There's way too many bear bars, much better to sell. And we basically got 5 or 6 bear bars in a row. They're getting smaller though, and the tails are getting larger. So it's hard to want to stay short in this area. But if you're trading, always in perspective, your stop is probably once you're at like the close of 55, you can just put your stop up on the 52 high, maybe a point above 52. Reason being that this is the top of a trading range. This is the breakout point below 51. And so the trading range might start at 52 if this is a trading range. And so if we turn up to here, we'll probably find more sellers than buyers. So you want your stop a little higher than that. 56 inside bar, probably sellers above, probably buyers below. You can see there were sellers above on 57, and then you get follow through, but it's bad on 58. It's just a doji. And then 59, in here, you got to be pretty careful. Once 59 was trading down, I probably would have moved my stop somewhere up here and be disappointed in the 59 close. 60 didn't quite close on its high, so no real reason to get out. Bulls are seeing, essentially a high 2 above 59, but not very good. 61, buyers below 60. 62, tail on the bottom, so probably still more sideways. It's a tight trading range. Even if there's a breakout, you're probably not expecting it to go very far, maybe for a measured move. I think we actually basically got a measured move, 2x the measured move down, something like that, to the 71 low. 63 follow through for the bears, 64 more follow through for the bears. So, basically bear spike, pull back, and now we're getting the second leg. You can think of all this as sideways price action leading up to the second leg. Once you get 63, I think a stop up here is fine. And definitely once you have 64, a stop up here is fine. I could even argue you can make your stop tighter and put it above 64, because if it trades up here, do you really want to be short? Not really. So you get follow through 65, stop above 65 is probably fine. Follow through, 66, but it's bad. You get one close below the day's low. Bears want a pair of closes below the day's low, but they weren't quite able to get it. So bad follow through 66. Another leg down 67. Probably buyers below, probably getting back to the 66 low. And you can see 69. So bad follow through 68 and 69. Low one short, sellers above 68. But probably not going that much lower. Surprise on 70 and 71, but probably getting back to the 69 low and pretty much cover your shorts above any bull bar at this point. You got to rally into the close. On the daily chart, we got a gap up, a gap down. You could look at this as a double top essentially with September 1st and September 12th. So some sort of double top here. The neckline of the double top would be 7th. So bears want a break below the neckline and measure move down somewhere down here, basically probably to this high and to close this gap. So that's what bears want. Bulls are hoping this is, they're in a tight bull channel, so they're hoping that we continue up and get some sort of measured move up, and basically a breakout of the channel or just any continuation of this broader bull channel. For always in positions, I think that it was always in long, probably on the close of 1, always in short on the close of 11, stayed always in short until 24. Bears tried to flip it to always in short below 37, but I think you need one more bar and traders don't get it. Always in short on the close of 51, basically until 72. Stop entries, I think 9's okay, but you got to be fast. 24 is okay, 11's okay. 46. And if you bought like anywhere in here, there really isn't a reason to exit until around this high and then probably below here. And if you sold here, there wasn't really a reason to exit until here. But it's hard to do that in a trading range. Yeah, that's basically it.